minus 100.01%. Take a moment to really let that number sink in. In the world of automated trading, this negative percentage represents the absolute end of the line. It's the definitive, inescapable conclusion to the GoldMining Guardian multi-major series.
Welcome to this explainer. Today, we're not looking at a celebration, and we're definitely not trying to spin some dramatic tale of failure. Instead, we're conducting a completely transparent, clinical documentation of a live trading experiment. We're going to systematically dissect exactly how and why this account hit absolute zero.
Okay, let's dive right in by establishing our baseline parameters. What you're seeing is the final state of a RoboForex live cent account. It began its life with roughly 2,500 cents, which is equivalent to about $25. The long-term objective of this systematic strategy was to grow that balance toward 10,000 cents, or $100. Just keep in mind as we review all this data today that the balances and figures are denominated in cents.
Section 1. The journey and the cliff.
Notice the stark visual contrast here. If you follow the timeline from left to right, you see a really steady, months-long accumulation of profit. The system was doing exactly what it was programmed to do across multiple currency pairs, just methodically banking those small wins. But then, on the far right, you hit that vertical, catastrophic cliff drop. That represents the total liquidation of the account in late June. It's an incredibly sudden, violent disruption of what was otherwise a perfectly stable equity curve.
The anatomy of that drop becomes really clear when we look at the balance versus drawdown. For months, the floating drawdown was successfully managed well within normal operational bounds. The system effortlessly absorbed the everyday ebbs and flows of the market. That is, until extreme macroeconomic conditions took hold, violently pushing the drawdown way beyond the strategy's limits and ultimately leading to total capital impairment.
Section 2. The Diversification Dilemma.
So the crucial breaking point is totally evident right here in the price action. On one side, the euro against the US dollar is aggressively trending downwards. On the other, the US dollar against the Japanese yen is surging aggressively upwards. What we're witnessing here is overwhelming systemic US dollar strength. During this specific week in late June, we saw a massive convergence of shifting central bank expectations, intense interest rate sentiment, and broader macroeconomic volatility. It essentially created a one-way street. The US dollar acted as a unified macroeconomic force, causing completely different currency pairs to aggressively trend against our automated positions at the exact same time. And this brilliantly illustrates the inherent limitation of our setup. Here we've got the US dollar rallying against both the Swiss franc and the Canadian dollar, with the CAD also being heavily influenced by volatile oil market dynamics at the time. The core theory going in was that spreading our exposure across four major pairs would reduce single-pair dependence. And in normal conditions, it absolutely does. But it offered absolutely zero protection when safe haven flows and a unified dollar surge swept through the global markets. The pairs didn't hedge each other at all. They all moved against the account simultaneously.
Section 3. The mechanics of margin pressure.
Tracking the deal activity reveals these frantic, towering spikes right around June 24th. As the US dollar relentlessly pushed the market against the open positions, the automated system reacted exactly according to its programming. It attempted to average its way out of increasingly bad positions by opening even more trades. It was literally a mathematical fight for survival. The system executed an absolute flurry of trades across all four pairs in a desperate attempt to find a market reversal that, well, never actually came.
Now, the immediate consequence of that frantic trading activity is a massive spike in margin requirements. Pay close attention to the deposit load, which represents how much of the account's available margin is tied up in active trades. Notice how it suddenly skyrockets into a vertical wall right at the end of the timeline. As the algorithm opened more and more positions to fight the trend, those margin requirements rapidly choked out the account's free equity, completely suffocating its ability to weather any further adverse movement.
That vertical spike culminated in a maximum deposit load of 444.57%. Clinically speaking, this represents a totally fatal level of leverage. When an account's required margin radically exceeds its equity to this degree, a margin call is no longer just a possibility, it becomes a mathematical inevitability. At that point, the broker's automated risk management systems have no choice but to step in.
And this cascade of red is exactly that. It's the broker's forced liquidation process in action. The system was closed out trade by painful trade.
This is the exact moment where floating negative equity, those mere paper losses we monitor, was brutally crystallized into permanent, realized losses. The account was bled dry, not by one single bad trade, but by a systemic overload that triggered a margin stopout.
Section 4. Extraction of data.
So, here is the final clinical autopsy report. The gross loss totaled over 6,700 cents, leading to a maximum drawdown of nearly 95% right before total liquidation. But I want to draw your attention back up to that starting balance of $25. While the strategic loss is absolute, a complete and utter failure of the system under these specific market conditions, the micro-account structure worked exactly as intended. The actual financial damage was strictly contained to just $25. This right here is exactly why we test in live, scaled-down environments.
Which brings us to our core lesson, captured perfectly in this statement. Diversified trading reduced single-pair dependence, but could not eliminate systemic market risk. When all your distinct currency pairs are ultimately tied to the US dollar, a unified macroeconomic shock is going to bypass your diversification entirely. So, I leave you with a provocative question to think about. Moving forward, how must algorithmic logic adapt to survive the unavoidable reality of extreme systemic anomalies? Because as we've just seen, these anomalies aren't a matter of if, but when.
The knowledge we've gained from this total liquidation is genuinely invaluable, and it will directly inform the future development of the Guardian strategy. We document these losses just as meticulously as the gains, because honestly, that is the only way to build true algorithmic resilience. Real accounts, real risk, real progression.